Hey everyone, Weston Nakamura from Real Vision in Tokyo. So today, I'm gonna give my own personal sort of takeaways on a Real Vision video that is out on the Essential tier. This is David Rosenberg being interviewed by fund manager Alex Gurvich on the topic of recessions and inflation, which is this broader theme that we're working on here at Real Vision. And this is, generally speaking, this is something that I just used to do on the Real Vision Exchange. Like, I would just give my own personal sort of views or takeaways from, a piece of Real Vision content for various reasons. People found it to be helpful, mostly because it's not just the content itself. It's not like a breakdown necessarily or anything like that, but it's more so like how I'm processing things and how I consume the content. Because at the end of the day, I still consider myself to be a Real Vision subscriber who happens to work at Real Vision. So I'm going to do that for this. And the reason that I'm doing that for this particular video is because, look, we've all heard like a thousand of these arguments, right? Like these inflation and recession sort of back and forth, and we all know like both sides of the talking points for both sides and all that kind of thing, right? And so why should you watch this one, right? Why should I watch this one? Well, I'm going to tell you why. This is the point of this. So this is actually a great interview or discussion or debate or however you want to phrase it, because they're both like great complementary counterparts, and they're coming from different functions and roles, right? So you have David Rosenberg, who is an independent economist and analyst who runs his own research shop. Then you have Alex Gurvich, who is an independent fund manager who runs his own shop. Independent is the key phrase here, because independent, as in not an employee of a giant bank or an asset manager, independent in both cases means that they have personal skin in the game in their own respective realms. And their personal compensation directly hinges upon how well or not they do, whereas employees of major institutions, they're there for a salary and an unconditional bonus check. Or, as I like to call it, just to throw it right back at non-millennials, institutional bonuses are the finance industry's version of a participation trophy. These two don't get participation trophies. They are compensated or not based on a meritocracy. And then Alex Gurvich, for those of you who don't know, so he's a global macro hedge fund manager, and he specializes in like trading mostly like rate derivatives directionally, and he uses a strategy of like price action reflexivity, which is like a sort of a Soros style strategy. But basically what that means is that in order for him to have been as successful as he has been for as long as he has been, it's not just about having like a deep fundamental grasp of the economy, which he obviously has, but far more importantly and far more difficult, he has to have the ability to like recognize a wrong call early and then even flip direction on a position, and just really obey like market momentum and velocity, right? So he's always screening for like different opinions and trying to find holes in his own argument or thesis, and so this is a very like important and sort of interesting context to keep in mind as you watch this video, because in this video where Alex is interviewing David Rosenberg, you could see he's very much doing this like in practice, right? Like, in fact, he basically like explicitly says like he's a trader, he's not an economist, and that every time he tries to act like an economist, it doesn't work out well for him.
This is an interesting interview because I tend to agree with David on many issues, even though I did have some differences. There were times when I wanted to debate him a little bit, but over several years, I tend to really think of him as like-minded person. So I think I'm going to make an effort to be a devil's advocate on this interview, because I find it's very useful to actually attack people who think like me and to test my own views and test my own thesis.
Now, as great and as sort of legendary as Alex is, this is an interview of David Rosenberg and his views. So it's Rosenberg's like views and thesis that's like under the spotlight. And I gotta say, like, he really does like knock it out of the park. He does a fantastic job at doing a few jobs, really. Not just that of an economist, but he's also wearing kind of a strategist hat as well, which is something that you never ever see. You always see like this division of labor, which is incredibly stupid because, as we individual investors know, we are one person, full service investment banks, right? We have to do analysis, we have to do portfolio management, we have to do trade execution and trading, we have to do risk management, all of that stuff, right? And also, what's great about this is that right off the bat, Alex comes out. I wouldn't say comes out swinging, but he basically says like, Rosenberg, you had a view that inflation was basically transitory or was not coming or whatever. And so he kind of says like, do you want to update your view or anything like that? And so right off the bat, you're starting from a position of Rosenberg is wrong.
I have made adjustments to that forecast, and my views on inflation have changed certainly for the very near term. And I think that if we had to define transitory, which of course has become a dirty word in the financial market lexicon, I guess if we were going to define that as being months or quarters, it's clearly not the case.
By the end of it, you totally forget that he was wrong. He sounds pretty damn convincing to me. So David Rosenberg has this view that there will be a Fed-induced recession that's coming sooner than later, like within 2022, and also a potential CPI slowdown as well. Now, what I like about Rosenberg is that he does what economists, by and large, just don't, which is that he puts out like this forecast, contrarian otherwise, right? And then he actually has like an actual like near-term time horizon defined, and then gives specific reasoning for it, right? So whether or not he's right or wrong, we shall see. But at least he's out there with something of definitive and like actionable, like insight to work off of. So for example, like he's picking apart major components of CPI, like housing rents that will be a drag on core CPI starting as early as this summer.
You have such a monumental, it's going to be such a tsunami of supply of rental units hitting the market in the second half of this year. This is not next year's story. This is going to be happening in real time starting this summer. We're going to be adding almost 2% to the rental housing stock in terms of the completions that are going to be coming on board, 2%. Which is double, the natural growth of rental demand, which is 1%, which is telling me what? Telling me that vacancy rates will be hooking up. By the way, it's already starting. And the rental inflation, keeping in mind that rents are 30% of the CPI in total, 40% of the core. That's going to be the big surprise.
But ultimately, Rosenberg, he doesn't like speak and think in like definites. He thinks in terms of probabilities, and he lays it out like in a very cut and dry sort of way, right? So what his thinking is that in the last several decades of the post-war era, right, Fed has undergone 14 rate hiking cycles. 11 of those 14 led to a recession.
There's been 14 Fed rate hiking cycles in the post-World War II experience, 14. 11 landed the economy in a recession. I'd pose the question back to you. Is that just a coincidence? Or is it really a pattern? And the Fed has had its thumbprints on every expansion, on every bull market, on every recession, and every bear market. The Fed has had its thumbprints. And you say, okay, well, you mentioned that there were 11 recessions in the context of a Fed tightening cycle. What happened the other 3 times? And that's what the Fed is aiming for, is what's called the soft landing, where the economy slows. It slows enough to create some excess capacity in the economy, and inflation comes down, but the economy doesn't go into reverse.
And then he sort of lays out what those 3 sort of, soft landing scenarios were. So, like, first one's in the 1960s, LBJ, Great Society, like fiscal spending, the triples, right? That's not happening. You're not going to get fiscal spending to triple in the United States in 2022. The second one was like the mid 80s. Fed raises rates, but there's a soft landing because the Saudis boosted production of crude and they dropped crude prices down 60%. 60% drop in crude is equivalent of like a major tax cut. That's not really the case today with, Saudis having very little excess capacity. And then the third one was Greenspan in like the mid 90s, raises rates from like 3% to 6%, but no recession because economy goes right into like the .com growth spurt. But what major innovation is there right on the horizon, like Netscape going public? What's there like right now, right? So those three sort of outlier instances in which I wouldn't like. I don't know why he calls them like a soft landing. It seemed like they were exogenous factors that happened to coincide with Fed tightening and that basically saved the Fed for them. It wasn't really like they landed the plane softly. And then what does Rosenberg do? He puts on his market strategist hat and he does a pretty damn good job of doing so, if I must say so myself.
Yeah, as we speak, just in the past few days, the real yield or the 10-year tips have actually flipped positive for the first time since March 2020. So you've had the situation where, and this is because the Fed wants to tighten financial conditions, and they've signaled that, so the real interest rate has reflected that tightening in financial conditions, which you're already starting to see as well happen when you look at the mortgage market. You look at the most speculative tranches like triple C versus double B spreads in the junk bond market. And the stock market right now is held in quite well because, what are the sectors that have been making new highs have been the stuff you want to own in a recession, utilities. What does it mean for a stock market where utilities, which is the poster child for a recession sector, is at a new high? Healthcare, consumer staples, and of course energy.
So Rosenberg says, like, all right, you want to be long treasuries and cash and not stocks for this next directional move. And you do so, thinking even one step ahead. You do so that you can start getting long equities when SPX starts approaching, I think he says, like around the 3,600 level, according to his like sort of valuation models. And then he breaks down like what the various like kind of options are for within each asset class. Now, one thing I will say that they pointed out that I'm so glad they did is China's COVID zero policy, right? So Rosenberg says China's zero COVID policy. First of all, that's been a huge, cost push shock. And can and will they ditch it, right? And like that's what my thinking has been. Like there actually is a sudden flip switch to inflation expectations via China. Obviously, like it's not like all inflation everywhere, but that is a major component of inflation. And all that needs to happen is Xi Jinping just changes his mind about zero COVID. And the moment that like that, increasingly indefensible policy ends, you're going to see like huge repricing in, commodities, in like, the energy sector, in yields and treasuries and everything, right? In currencies.
You're going to find historically that when their import growth is negative, which it is right now, commodities follow suit. The year-over-year trend in commodities goes negative 90% of the time. So
that could happen at any moment. That's just one guy who needs to literally flip a switch in his head. And it's probably going to happen around the time of the party Congress, if anything, or sooner if it gets too unbearable. But it could happen at any time. So it's something to think about. Something that's been in my head is one of like the sort of risk scenarios in my head, and I'm very glad that they brought that up. Ultimately, when I watch a piece of content, and when I make content for others to watch, I just have a very basic and straightforward way of judging whether it's worthy of time and attention. And that's simply, am I smarter or am I better informed than I was before I watched it? And if the answer is yes, then it's probably worth watching. In this case, the answer, at least for me, certainly was yes. And Alex and David Rosenberg, if you happen to be watching this, fantastic job to both of you, and thank you for sharing your insights. And thank you to all of you out there for watching this, and I hope this was of some help. We'll see you next time. Thanks.